Hey everyone, welcome to the KE Report and a daily editorial on this Monday, March 10th. Chatting with Joel Elconin, co-host of the PreMarket Prep Show. Also check out the PreMarket Prep website, which we will post a link to in the show notes. Joel, we always bring you on to talk trading strategies for markets, a wide range of sectors. The problem being right now is it seems like these markets are very much in a way in crash mode. It's definitely in correction mode here, but boy oh boy, just starting off this week, we have the S&P down over 140 points, right about 2.5%. The Dow's down 1.5%, almost 700 points. The NASDAQ, that's down almost 4%. Russell, that's down almost 2%. It is another sea of red in these markets and really seems to be pulling down everything that I'm seeing. The odd defensive play is working, but quite frankly, it seems like sell whatever you have and maybe move into cash. So, Joel, look, we've been chatting with you over the last few weeks, and you were saying just how weak and bad this market was looking. It's simply picking up steam to the downside. So, Joel, make sense of this. Is this truly a market where it just seems like we need to pull off, move to the sidelines, and see where this goes?
Well, thanks for having me. I don't like to give dire predictions and stuff. I try and take the markets on, at least on my short term, view of things on a day-to-day basis. And right now, there's just very limited support in the market. Technically, we could talk about that later, but fundamentally, there's just a lot of things that are going on. And one thing that the markets and market participants and institutions do not like is uncertainty. And as we were discussing off air, we are perhaps at the most uncertain period of time in, and I won't say decades, I'll say centuries. And that's where we're at. The changes that are going on geopolitically, we still don't all have all the ramifications of, but obviously, market participants are not waiting around to find out.
Well, Joel, when you just think about it from a valuation standpoint, a lot of people were banging on the drum the end of last year saying maybe these valuations have gotten ahead of themselves. When you looked at the PE ratios, when you looked at the price to forward earnings, a lot of these things were super stretched at super frothy levels. Isn't it good to cool off the markets once in a while like this?
I think it's good to cool off the markets, but I think that what the algorithms don't know when algorithms don't care about valuations. Program trading doesn't care about valuations. When you don't have rational people making decisions behind a lot of the trades, it's just all algorithmic. And right now, the algos are they're rigged to the sell side. And that's not going to change until there's some kind of fundamental changes or some kind of clarity that's going on. It's There's just too much, as I used the term before, there's just too much uncertainty out there. And I think that the biggest fear of the market right now is the impact of what the U.S. policy is going to have on the U.S. economy. And we are already fighting inflation. If you look at the basis of what's going on with the policies right now, through the three main things are not good. One is tariffs. We all know tariffs are inflationary. They're going to be. You can say they're not. You can say taking some air out of the dollar is going to lessen that impact. Tariffs are inflationary. Number two, and I'm not one to say what government jobs should be kept and what shouldn't be kept, and if there's any inefficiency in the U.S. government. But when you cut jobs at the rate that you're cutting jobs, you are going to have less employment. That is not, I'm not making a statement that Milton Friedman made up. Okay. Number three, less spending, less government spending. And once again, I want to make it clear, I'm not saying that the government hasn't spent. I'm not saying that there's a deficit. I'm not saying that there's things being paid for and funding there shouldn't be paid for. But the combination of those two things really can only lead to that one outcome. and that's a recession in the United States.
Joel, how much of this too? It's something that I've been thinking a lot about, and people say, look, we voted for Trump because we want less wars going on in the world. But the fact of the matter is, we're in a trade war right now. This is a different type of war that is being fought pretty much globally, starting at the U.S. The U.S. is picking this fight with so many different countries, whether it's because they think that they're behind on trade, whether it's because they think other countries are taking advantage of them, whatever reason that might be. Fact of the matter is, we have a trade war ongoing right now. Is this the biggest problem with these markets? Is that, yes, we already have these other wars ongoing, but this trade war is arguably more market impactful than the other wars going on, and we need to take, I guess, a strategy to trade these markets like we are in full-on war?
War is war. War is war. A trade war is no different than, a military war. And a trade war can lead to a military war. So that's a good word to use. And I'll just say that the U.S. has put itself at war with the rest of the world. So when you're in a position where you're not that well liked in the first place, adding to that fervor cannot be a positive outcome. And the wars that are going on in Russia and Israel, I mean, those things are only going to be accelerated by what the circumstances are. I don't know. We don't want peace with anyone, I guess, is what the mantra would be. Or everyone's been taking advantage of us for so long that we need to stick up for ourselves. And this is what we're doing.
Well, Joel, in light of that and global trade and perception of the tariffs and what that'll look like in a trade war, why do you think it is that there's still so much capital that's flooded into the U.S. and the dollar? And do you think that will change? Will we start seeing outflows of the dollar and into other markets? Is that why we're seeing Europe have a rally?
You're seeing that right now. You're seeing that right now. I mean, the money is fleeing the United States hand over fist. I mean, the EM is not a nice move. I mean, I'm just astounded the way, the Canadian ETF has been holding up. China's had a miraculous, a very nice rally. That's up considerably this year. If you look at the German ETF, that is at an all-time high. So yeah, they're actually, oh, no doubt, this is an exodus, and it's leaving the U.S. markets. It's leaving the U.S. dollar. Another thing that you got to think about is when you invest in these other countries and you're investing in their stock markets, is that, well, if the stocks appreciate, on their own, based on their own fundamentals, that's good. But you get a double kicker is if it's a declining dollar and you're invested in that other currency. So you're seeing the mother of all rotations here out of the U.S. markets, out of U.S. equities, into just about everywhere else.
What does this mean for the dollar? Then, Joel, is the dollar losing its purchasing power? Is it losing its world dominance? And quite frankly, could we just see the dollar continue to move lower from its current levels?
I mean, it's already taken, quite a haircut right now and got back up to those levels from 2022, early in 2022. I like to look at the dollar index futures. I don't, I know everyone you could look at the cash equivalents and everything, but on my chart, looks like this thing is currently trading around 104. Looks like it has a date with $100. And that's was levels that it was back up in late 2024. So I don't really see, I do see one other monthly low here. We're kind of where we're at. Did we bounce? No, we didn't get that low. And this is just basis the futures. I'm not like going in all the conversion rates and everything. But based on the futures, man, you had that big rocket ship move from 100 to 110. You couldn't hold 105, which is a 50% retracement of that move. To me, it looks like, going back to $100.
Well, there's some people that would actually like to see the dollar drop back to $100 because it would be good for certain markets. It'd be good for commodities. So it'll be interesting to see what happens with the greenback. But Joel, I'm going to have you take off your geopolitical hat and put on your technical hat when we look at the big markets. But I want to zoom back, not just the short-term daily noise, but let's look at this from a bigger picture perspective. From the great financial crisis to the last year, people could argue that with the exception of a few little pullbacks, and the 2022 one was a cool down period, this market has been on a nonstop steamroller ride up to the upside. Could it mean that we also, after that big of a bull run from basically 2009 to 2024, with a couple breaks in between, isn't there still some room to knock the excess out of this market maybe for a year or two?
You know what? Let's not go back that far. Okay.
That's when the run started.
Well, I mean, we've always kind of been in a bull market, but let's just get, because if I start to give you levels for that, then your people aren't going to be happy. So instead, what I'd like to do for this example is I'm going to the S&P 500 cash, and I'm going to that recent high, which is just about 6,200, and I'm going to the COVID low. Okay. I'm going to go back there because that was over a 4,000 point rally. Now, if you're talking about a meaningful retracement of that basis the S&P cash, that's 4,200. We're currently at 5,600. So that, if you want to take on, and I've seen a lot of 50% retracements in the day that I never thought would happen, theoretically, that's where the market could go down to, is 4,200. That would be my stopgap. I don't even know what prediction that would be on a time frame. But if you want to, tie down to the table, sit tight, and you're a long-term investor, and you want to be out of the market, then wait for 4,200. If I'm going to be a little bit more cautious because the way this market is and the way it bounces, and I'll be a little bit more optimistic, I'd say 5,000, would be a possible stopping point. That would be 632 basis points from where we're at. So that would be a number to keep an eye on. If you wanted me to be like a positive guy on a daily chart, I could give you a number where there was an area of low. I would say short term, 5,600, but that's like, that's only 24 points away. I mean, we could be there by the close. So, if you want to put, I don't want to go back to 2008 because I like to have levels that I could at least, I can see them on my dailies, but those would be meaningful correction points on the downside.
Okay, so Joel, let's just take a step back then, okay? Because look, the market's right now, S&P down 8% from its peak. And again, it was all-time highs throughout all last year. We haven't seen the S&P down 2 months in a row, especially with that second month being significantly down like we're seeing this month, since late 2023. You're saying 4,200 could be a level. That's 25% lower than here. That's a serious correction. But an 8% correction, that's not out of the question for still generally strong markets. Again, we're down 5% just this month. We're only on the 10th day of this month. Is that the problem right here, is that it's dropped so much this month so quickly that everybody is so scared, and that could just lead where buying leads to more buying, selling leads to more selling?
Yeah, I mean, if especially when there's alternatives out there, and 5% cash instead of what? I mean, depends on your stocks, but I mean, double-digit declines. Tesla down 13%, Broadcom down 9%. They had earnings on Friday. It had a decent day. Apple down 6%, Nvidia down 5%. I mean, why put yourself through that kind of aggravation when there's a lot of good alternatives out there?
Joel, what do you think about the value sector starting to attract more interest? Because everybody's been growth, but we're seeing a little bit of life in things like the utilities, consumer staples, bonds, gold. Do you think that maybe this is a return to the value sector?
It already is. I mean, look at Berkshire Hathaway. I mean, that of all one of the few stocks in the S&P 500 that's trading up today. I mean, it's trading just under 500. Its all-time high is at 518.77. Everyone could get on the Kathy train and make fun of Warren Buffett, but accumulating that cash like he has over the years, sticking to his guns, I mean, you're seeing a fundamental shift. And yeah, out of growth into value. And because of the valuations, what the problem that you run into with growth stocks is that what they're momentum stocks, right? And so when the momentum is there to the upside, people can't get enough of it, right? And then when the algos flip to selling the momentum, okay, the Momo buyers are out. The Momo buyers turn to sellers, correct? And so who's gonna be the buyers? Well, the buyers, they're not down there until things get to reasonable valuations. And on a lot of these stocks, we are far from that level. So the momentum is turned. Value is what you place on it. But right now, even stocks that are getting good pops off their earnings and just ain't holding, and they're just going down. So we are, and also I think that, yeah, you can bring in the valuation thing or whatever, but you put on top of that the geopolitical situation, and there's just no reason to be a hero out here with the geopolitical, with the fundamental. Who knows what our inflation? I tell you, we get some bad inflation numbers on Friday. Holy mackerel! I mean, and I hear so many people say, "Oh, Trump does care about the market. Eventually, he's going to turn." Well, that's not a good investment philosophy, or at least it hasn't turned out to be this point. And then when he does turn on it on something, then what do you want to be buying that 6, 7, 800,000 point rip in the S&Ps or in the Dow Jones? No. Once again, and we can wrap it up on this. It's where you at in your investing cycle. And I've said this 1,000 times on your show. If you're nearing retirement, you have kids going to college, you have different things, then you got to look at the market and see where you're at with those investment objectives. If you're relatively young, like you guys, buying good companies at reasonable valuations after, I mean, don't, not trying to catch a falling knife, but, get your monthly charts out, see if the monthlies can, align with some former tops, and perhaps, do some buy the dipping. But we're in a very treacherous investing environment for now and for the foreseeable future.
Yeah, well, right now it really feels like you're trying to catch a falling knife. The only thing I'm really seeing on my screen is up today are bonds that are up a bit. The VIX is up. VIX is really up, but other than that, man, oh man, it's just a sea of red. One other curveball to it then, Joel. Can the Fed save these markets? Is the Fed going to throw its hat into the ring and say, we're getting ahead of Trump, whatever they might be able to do to give investors some sort of comfort?
That's what kind of people were thinking on Friday when Powell was speaking. But, they've said that they're focused on inflation too. So maybe, if you get some weaker inflation data on Wednesday and Thursday, maybe that might signal something. But the Fed has bailed us out so many times. I just don't think that a quarter or a half or interest rate cut is going to be the panacea to turn this market around. There are too many other structural things going on besides what interest rates are.
All right, Joe. We'll wrap it up here. Boy, oh boy, who knows what we're going to be talking about in the next couple of weeks. But this month, again, one of the worst months we've seen in the markets for quite some time, a couple years, and we're only in day 10. So let's see where this bottoms. But boy, there doesn't look like there's a whole lot of safety out there to me, at least on a day like today, which just goes to show if this picks up steam, some momentum even to the downside, which we clearly have, even since we've been talking, markets have just been crashing. It just pulls down everything. Again, Joel Elconin, co-host of the PreMarket Prep Show. Click that link in the show notes to visit PreMarket Prep website and listen to the replays of Joel's show. Joel, always great chatting with you, man. Thanks for your time today.